dang it, I was right. Christmas. What is the
Nightmare Before Christmas.
Nightmare Before Christmas? I've never actually seen it. I know
I'm
Tim
shaking my
Burton
head
did the
quietly.
music. Have not seen it, but
Yeah, you can't like that. How do you like Danny Elfman and not listen to
well,
it
I
at
like Danny
least?
Elfman. I don't know. I mean, I guess I like Edward Scissorhands. I like Beetlejuice. But yeah, I don't know. That just kind of came out. It just never really enticed me to watch it. I've seen scenes of it.
Mm-hmm.
But
Mm-hmm.
anyway, Halloween's Christian D's favorite movie. Yeah, there we go.
Who's the favorite movie?
Halloween.
Yes.
I saw like a meme video yesterday. It was like Mike Myers, which is the killer in Halloween. He's at home plate and he hits just a grounder like just to the shortstop. And of course, when Mike Myers, he never runs, he just walks.
Mm-hmm.
And no matter how fast you run, he's going to overtake you with his walk. And all of a
Mm-hmm.
sudden, he shows up on first base and he's safe. But anyway, so Blake, we're going to talk
Yes,
Oracle today.
we are.
I mean, and I kind of thought, look, okay, we're talking about the debt offering and the broader implications, but I thought we could start off with just talking about Oracle and say, let's just analyze Oracle's fundamentals and say, okay, what's this company worth? Would you really loan this company $38 billion? So we're going to be the bank.
Mm-hmm.
And Professor mentioned Wells Fargo not shorting them. Well, Wells Fargo is going to be one of the banks involved in this debt offering. A bunch of them are just lining up right now for it. And we're going to make a decision. Is Oracle a good credit risk? What do you think?
Well, the short answer is no. We don't have
What do
to
you think
take
about
any time
that agenda
of lining up and there we go, we're done. Thanks for coming. No. So, this is something I've been doing for the last couple months is I keep going back and say, pay attention to the debt. Act like a banker. I've sent out multiple articles talking about this, and I've had people disagree with me and argue with me and send me emails that they're upset with it. But reality is, I keep saying, think like a banker, not think like Wells Fargo, because Wells Fargo has a history of doing some really sketchy stuff anyway. But think
Absolutely.
like a banker. If your job was dependent upon the success of the loans that you lent money on.
Right.
So stop thinking about it like, well, what if Wells Fargo is trying to get in and make a connection to something else that maybe they shouldn't, or doing egregious offerings or anything else like that. We're talking about if you're in this position of being the mortgage broker. You're sharing your full screen there, Brandon.
Wrong screen. Why does it do this? It shares the wrong screen.
Yes.
Top share. It's done that. It's done to me several times. I'm like desktop 2, and I share it and it goes to the wrong one. Anyway. Yeah, and that's I meant to go to ORCL, but yeah, and that's a great point. Is that Powell just announced yesterday, right? We cut a quarter point. We may not cut in December, but we're stopping quantitative tightening. And it's like, I mean, the reality is that we're cutting rate and engaging in quantitative tightening at the same time is moronic, right? They should have been engaged in quantitative tightening way earlier, but instead we decided to raise interest rates from 0 to 5%, 5.25%, 5.5% on mostly on who? On us, because all these big companies took on massive debt back in 2021, largely helped and supported by the Fed at the expense of inflation to expand their balance sheet. Now they've sold those assets, those junk bonds and other bonds they bought for Apple and Toyota and Ford and all these companies. But now I feel like we're going the same trough again. I mean, we could be really helped as a consumer base if they keep cutting a quarter, another quarter. And okay, but we're gonna so we're not gonna cut next quarter, but we're gonna stop quantitative tightening, because who does quantitative tightening really hurt? It hurts those that have access to that money and over levered. So I feel like we're just kind of resetting the game to bail out companies or banks like Wells Fargo when all of these bad investments start to come home to roost. And we're going to talk about one area here in AI. So let's take a look at. Let's go ahead.
No, I was going to say that I had someone talking about the housing crisis and say, oh, but disinflation, since we don't have any data and we know we're in a stagflation environment, since we're not getting the data, people said, oh, but inflation helps the borrower, therefore a disinflation or deflation helps the banks. So if we do push that direction while we're cutting rates, if we do see disinflation, then the banks are going to be fine. The problem is the banks are over leveraged, and when those assets are repossessed or pulled back in or foreclosed on, they're holding an asset that's not worth what they lent on. And then they have to liquidate it, and it causes it to accelerate even lower, even faster. And that is the issue. So when you're over leveraged and it starts to crack, like you said, it does set up for bailouts and everything else like that. But the fact is that they are repossessing on cars that were lent at the maximum peak, that lost, depreciated, and were overpriced anyway because of the chip shortage and everything else. They're leveraging up on houses that could be pulling back. And then when they have to fire sell them for another 10%, they're losing 20% or more on full value, on these assets. And so it just causes this hemorrhaging. So disinflation does not help the banks in this situation because they're over leveraged. If they weren't over leveraged, it'd be a different story.
That's the thing is, I mean, the Fed expanded its balance sheet to $9 trillion. They've scaled it back to 6. But when you pump that money in the system, that's just, we got the monetary stock. The Fed doesn't control the money supply. It requires banks that takes then those dollars and then they leverage those dollars by offering loans. And banks have done pretty well, right? But the reality is, just like in the housing bubble, they do really well for a while. But once the credit that's out there starts to contract, we write stuff off, then the money supply starts to shrink quickly, which creates disinflation or deflationary pressure that the Fed's going to try to alleviate. But the hole that's left, the Fed's trying to fill it. They can't do it fast enough. And this is what causes these major contractions. And when you look at Kraft Heinz here, big drop yesterday. If you're not buying premium ketchup, Blake, I mean, can you afford to go to CMG? Apparently not.
No.
Right? If you're not buying ketchup, you're not buying the big burrito for $15, and you're not going to go $2.50 and put the guac on it. Don was talking about Starbucks, how the guy moved from CMG over to Starbucks. Are they going to start to charge $2 for whipped cream on your favorite beverage? I don't know. I mean, but this is kind of where we stand right now. So
but you can't get much worse quality. So there you go.
Yeah, I don't know. It's
CMG is going to be Taco Bell level quality here soon.
Right. Well, yeah. So the premium ingredients, what are they going to do to downgrade to be able to meet consumer demand?
Yep.
The Del Taco is still good, right? You get lots of cheese, some lettuce, tomato. You get the ground beef. The beef's not quite as good as like Taco Bell. I like their beef a little bit better, but yeah, we're going to go ground beef. They're going to have to go away from the carne asada menu to the what's left over from the carne asada,
or the ground beef with vegetable protein mixed in. So
anyway, right. Yeah. They'll sell it. Okay. All right, let's
one way or the other. That still comes down to this concept and this idea that the consumer still has an influence on all those companies. And if you're not bringing in revenue, if your margins are getting smaller, if your costs are going up, this is a catastrophe. This is a catastrophe waiting to happen. And we're talking about the idea that we've got to keep inflation in check, but we're flying blind because we don't have a month's worth of data now. And we're making decisions, both investors and the Fed are making decisions off of guessing.
Yeah, mystery meat. We used to call it monkey meat. But anyway, Taco Bell. So let's take a look at Oracle here. So again, we're trying to make the decision. Would you loan Oracle $38 billion? Again, if we're looking at, if we focus on the profitability aspect of Oracle, we look at this company, we have gross margins 70%. How in the world does a company have 70% gross margins? That's basically revenue minus cost of goods sold. So what is it that Oracle actually manufactures?
Reality, even though, there is power seats in softwares, it's SaaS and Oracle data center software. It's the background. I don't know if software is really right. They're not making anything. So their cost to make those things are nothing, right? We have all three, and I don't know if people know this. I don't know if you know this, Brandon.
No.
When I had my data center, I actually built a data center with my business partner, and we merged with the company that was the #1 Oracle power seat seller in the nation at the time. Sorry. So we actually merged with a big Oracle dealer, And it was all about those power seats. So any corporate, any enterprise group that wanted to use Oracle, they paid per seat. They paid per software license, if you want to call that. So it really comes down to the license. That's the word I was looking for, licensing. And so it doesn't cost anything to replicate a license.
Right.
It's just saying push a button and then now you can be on, and now you can be on. And that's been great. That's been their business model since Larry Ellison started fighting with Bill, trying to be the richest guy in the world.
Yeah. So
And
yeah, we're talking about a data
changed.
center here. I mean,
Yeah.
how many data centers have they ever built? I mean, are they actually? Oh, I mean, there's lots of
Well,
logistics here that kind of
yeah.
create interesting
Back in the
scenarios.
2000s, we were the ones, everybody else, we were the ones building the data centers.
Yeah.
And they were the ones providing these softwares, and we'd put them on EMC disk arrays and Sun servers and all this, and Oracle would reside on there, and we would pay for more seats as we brought in more clients. But at this point, what's going on with the idea of building data centers? And I'm telling you from firsthand experience, this is not hearsay. It's expensive to build a data center.
Right. Absolutely. Right.
It is very
And your
expensive to build a
margins
data
must be
center.
fantastic for data centers too, right?
Yeah,
Maybe not.
it's kind of like the grocery store. But for the
Yeah.
amount of cost you put in, the number of people you can put into your facility is, your margins don't go perpetually higher and higher because you're never re-incur the cost of the software. This
Yeah.
is the deal that you pay this, and if you want to grow, you pay it again. If you want to grow,
Yeah.
you pay it again.
And this is a really interesting dynamic because again, we have a lot of companies that have phenomenal margins only because they don't manufacture, right? They don't really have a lot of infrastructure costs. So we look at operating margins, they dropped to 31%. Now we're subtracting off selling and general administrative expensive, SG&A. We have net margins once we factor in other factors. We've got 21% net margins. These are phenomenal numbers. You get gross margin over 40%, net margin really over 15%. That's great. And for this size of company and the amount of revenues this company generates, even getting 7% net margins are good. So this is a phenomenal business. The only problem is how do you grow it, right? So the idea is if we can get more and more revenue in and we can filter it through this process, this creates phenomenal income for the company. But the real issue is how do you grow it, right? So we kind of see a little over here. We have a bit of stagnation over the last 7 years, and we're seeing this going parabolic in essence from an earnings and earnings perspective. And so again, yeah, we want to funnel as much through this if we can maintain the same business. But we look down here, we see return on equity. So equity is what, Blake?
Equity, as far as return on equity, is the
Or just
amount of
equity in
share we're
general?
talking about. Yeah, I can say that's what you have that you don't have, assets that you don't have debt on, or
Right. So
assets really.
assets minus liabilities
Yep.
equals your owner's equity or equity.
Yep.
So when we figure return on equity, we're taking net income and dividing it by equity. Now, the smaller the equity, the greater the ROE, right? So ROE increases as we diminish the equity in the company. So we see 72%. But we take and we de-lever this, and we just focus on the assets part of it, and we take net income divided by assets, then we get return on assets of 7%, which is okay, but it's not phenomenal, right? And we figure return on assets, one of the things there's total asset turnover, right? So as we increase that asset base, how much can we turn it over on a revenue basis to be able to show efficiency of management? So while this number is extraordinary, this number is not. But remember, the difference, this 10x multiple is a function of debt. It's called your leverage ratio. It's we're talking about assets over equity, right?
Well, and let's restate that a little bit differently as far as what you're talking about, return on equity. This is the same thing that we've happened on earnings per share. If the company's saying we're going to buy back our shares and have less shares out there, it looks like we're making more money. We have better earnings per share because there's less
Apple.
Less shares. Yeah. Full. Yes. So it looks like we're making more money per share. Our earnings are going up because we're buying back our stock. We're not making any more. We're just using our cash to pull stock out so that number that we're dividing into the equity gets, or the earnings gets smaller. So it makes that ratio look bigger. you could be expending more and more money. You could be losing money and keep dropping that equity. You could say, look, let's get down to our equity is 0.1, 10 cents. You're going to have a number that looks like your return on equity. If you made $1, you have 10 to 1 return on equity. And so it's not a, you have to be able to look at the total growth. And one of the things that you have here on your chart is free cash flow. And that's the one that I pay attention to as you're doing this, because it's also debt contrived, because if we're building up our debt, we're increasing our capital expenditures. So free cash flow is your operating margins minus your expended, your CapEx, right? Capital expenditures.
Yeah.
And that's gone negative. So that's showing you that they've increased their expenditures or decreased their income to the point where we've gone negative on free cash flow.
As we look at some of these return on capital measures, I mean, this is a phenomenal number, 50.71. It's down quite a bit from where it's been historically, which is way, way out there, crazy. You look at 3-year return on invested capital, right? Incremental invested incremental capital, 2.6. Again, we look at it here. We're seeing, again, we're towards the median value of the last 2 years. So when we think about our return on assets or a return on incremental invested capital, we're seeing that there's this a little bit of disconnect in terms of returns there versus margins, because again, net interest margin is a function of return on assets and return on equity. Where we're seeing the bigger returns is because of the leverage, not necessarily incredible efficiency at using the capital, which what they have, which we know they're capital light a little bit because they have phenomenal margins, right? Again, software does not require, it's not like you're like, Taiwan Semiconductor. You have to actually make something, right? You've got a factory, you got all this overhead and all this other stuff. These companies don't really have that. Now, as we look, so the profitability looks phenomenal. I mean, if you could scale this, and all of a sudden we're turning over our capital, we're turning over assets greater. I mean, this could be a phenomenal business. So if we look at Zach's over here, I'm going to bring up, we're going to look at the detailed earnings history here for future projected earnings.
While you're doing that, let me start. You're talking about scaling. That's scaling existing business model.
Right.
Is Oracle planning on growing their existing business model, or are they changing?
That's the problem, right? So we have this phenomenal margin business. That's great. It's amazing, right? But the issue is that we're about to expand into producing and constructing data centers, which is very different than what we've done in the past. And so we look here, we can see that, look, we're growing revenue 16%, projected to grow revenue 16% this year, grow revenue 23% next year, right? And so again, these are really good growth numbers. We look at earnings estimates, the year-over-year growth here, 12% earnings growth, 18% earnings growth there. So we are saying, look, I mean, they're in a great position, right? They're seeing growth. How much of this is attributed to maybe future growth and revenues from the data center? Well, the OpenAI agreement is going to kick in 2027. The estimate trends have been phenomenal. They're raising expectations for next year in 2027. That's when the OpenAI stuff's kicking in. This year, estimates have increased a little bit. This company's, it's about batting 50% on beating earnings estimates, which isn't good, right? You miss earnings, that's a big deal because, 70% of companies beat every quarter. So again, we're getting some negative surprises in terms of earnings estimates. But overall, I mean, you're seeing, hey, the growth outlook here looks good. The question is the company cheap, right? So we're looking at the growth. We're looking at a phenomenal business model as it stands today. But what does the valuation look like? So we look down here at kind of this is Guru Focus, but it's a pretty good just kind of synopsis here. But the P ratio is at 60 times. So Blake, what would the earnings growth have to be for this company to be a value at 60 times PE?
I would say you've got to have at least, well, I don't know what number you like to use as far as a PEG. That's what you're looking for.
Yeah. So PEG, this is your price earnings divided by little g, which is growth. So value would be less than 1.
Yeah.
Right. Kind of moderate. We're kind of between 0 and 2. Greater than 2 is overvalued.
So you
greater
have to have
than
30.
3 is extreme.
Yeah. So if you
So
really want to have 30% growth per year
yeah,
to
and that's just to
hit the
keep
top
it.
edge.
That's to keep it just out of that extreme overvalued.
Yeah.
And we're looking at their growth rate for the current year or next 5 years. Next 5 years, past 5, next 5 is 17%. So the next 5, based on analyst projections, is 17%. We're almost 4 times that.
And that's
So
including all the AI stuff.
right, that all the projected stuff that we're going to get down the road, right? How it's going to translate to earnings. And remember, we might be compromising our margins here just a little bit because we're expanding into data centers, which again is not as a high margin of business, right? Well, guess what? And then we look at this valuation, we're almost 4 times the PE, which is way out there, right? We look at price to book value, 30 times book value. What's the market cap of this company? I mean, just think about this, right? 30 times book value. Well, book value is what? It's your assets minus liabilities. It's your book value of your equity.
If you
And we're talking
liquidated
about
the
a company
company,
that doesn't have a lot of
theoretically,
equity.
that's what you'd have.
Yeah. So we're talking about a company that doesn't have a lot. This is an $800 billion company, right? And it's trading 30 times book value. And we already saw up here that there's a lot of debt. There ain't a whole lot of equity here. And yet we're still trading 30 times book value, 12 times sales. I mean, even go out to what sales are project here, 82 billion. We were at 57 last year. We're still going to be 8 times sales in 2 years based on the current price today. EV to EBITDA, right? 34 times EBITDA.
Earnings
There
before
must be
interest, taxes,
phenomenal.
depreciation. It's basically
Yeah.
your most core earnings.
Right. This is the most comparable measure because we take out capital structure, right? So if you borrow a lot of money, another company doesn't, hey, forget all that. We'll get it above the fray. Very, very comparable. And enterprise value is what? It's basically your market cap plus your debt minus your cash. And so we're talking about extraordinary valuations. So this company must have phenomenal, not just 20%, right? We're talking about it have to be like 30, 40, 50%. This company must have phenomenal earnings growth expectations for 5 years. No, right? None of that. Now, this company, if you're going to lend money to this company, what do you want to probably insure, right? If you're a bank, you want to get your money back, right?
Yeah, you've got to have your margin of safety in that lending, that you know that there's enough assets and cash coming through to, 1, service the debt, and 2, if it fails, that you can repo the assets and protect yourself.
So we look right here, right? I mean, their cash to debt, right? They got very, very minimal cash. Now we'll look at their liquidity here in a minute, but debt to equity 4.36. After this is done, it's going to put them over 500% debt to equity, right? So these are big, big numbers. This is a heavily indebted company, which we saw right here when the return on equity is 10 times the assets, right? The leverage ratio. This is a 10 times leverage company, right? We factor in assets versus equity. So we come down here, we start to look at some of Blake's favorite measures, liquidity ratios, right? Current and quick. Blake, what does this tell us?
Means they don't have enough assets they can turn to cash within a year to pay what they owe this year. That's what that current ratio is.
So
now the quick ratio, they don't have a lot of inventory. That's why they're basically pretty close to the same number. So quick ratio just says, and you can't count inventory, turning that into cash. So
no inventories, but we can see here again, if you have, let's say you're going to pay, $36,000 for your mortgage payment this year. You've only got, you don't got that, right? You're not expected to generate enough cash to make your mortgage payment for this year.
That's
and now you're going
just
to go out there and borrow
snapshot. Yeah, that's current snapshot. Add to that, well, what about my income? I've got a bunch of income. No, they don't. That's why they don't have any free cash flow.
Right. So let's take a look at free cash flow here. So again, cash is, and again, this is where we're really, when we analyze AI, we're forgetting there's no cash, right? There's no cash changing hands. We see revenue, but no cash coming in. So we look at cash flows here. What is the company's free cash flow? It's negative. So when we take in operating cash flow, which is basically your net income. We start to add in stuff that are non-cash expenses, subtract stuff that we're added to. We got $4.7 billion in stock-based compensation. We got depreciation. That's a non-cash expense. That's a non-cash expense. We'll add that back in. So we get operating cash flow of 21 billion. But the problem is what happens here. We look down here, cash from continuing operations, capital expenditures, 27 billion, right?
7 billion.
So we're investing more than we're generating in cash and capital expenditures. So we still got to do this because we got to still maintain our business.
Well, and look at your,
And that's
go back to the
generating negative free cash flow.
Go back to that capital expenditure line. Right to left is older to newer. Okay. So to the left side is our current trailing 12 months. Look at what it's done. Yes, 2023 huge expenses and well, I go down to your capital expenditures. Yeah, just 2 lines. There we go.
Sorry.
Yeah. So we went from 4 to 8, and we pulled back a little bit. 21, 27. This is bad. Their capital expenditures have increased by 4.5 times. Sorry, well, from the 2022, we're talking about increasing by 9 times, or 8 times. 8 times.
But Blake, when you're such a rich company like this, is just flush with cash, you can buy property, plant, equipment, and do capital expenditures because you're not incurring any debt for that, right?
Oh, what, you don't have any cash?
That's the problem, right? So we look at cash flow from continuing operations. Again, we have this net issuance payments of debt. This positive number represents cash inflow. It means we're taking on debt. 12 billion. We paid off some debt there. 5.5 billion, 6.7 billion. And we're about to offer a $38 billion debt offering. But this company probably has very little debt, but we know that's not the case. We look at the balance sheet. I mean, how much cash, how much debt does this company have? Liabilities, right? So we have assets minus liabilities. Very, very little equity in this company, right? Very little. And they're about to take on 38 billion. And again, I doubt you're going to have 38 billion in assets here. We may see that this company may soon become a zero equity company. We had a very thin equity margin back here. We expanded a little. We paid off some debt, expanded it here, but now we're going to take $38 billion out. And so think about a company, a bank. If this company goes under, their assets are worth less than the liabilities, right? You're waiting in line. So what do we think, folks? I mean, is this the type of company you're just standing the ready to basically add, 20% to the liabilities of this company? And we think about total debt. Currently, we got some current liabilities, current debt, 7 billion, long-term debt, 96 billion. So we're going to add about almost 40% to the debt of this company, not just liabilities. Is this a company you'd really just stand in the ready and say, here's your money? What do you think?
Yeah, and you're going from 72 to 100 and almost double. You've doubled your debt in 4 years.
Yeah, so from over here, right?
Yeah, and if these numbers are just outside of what you would normally think of, back up and say, okay, let's remove a bunch of zeros on this. If you had an individual that had $72,000 of debt and had increased that to $140,000 of debt with no income, no net income, would you lend to them? That's what we're talking about.
Right.
Keep it simple.
And you're going to lend just to put in the house perspective, you're going to lend them more money than the home is worth. Right. And part of this is based on, again, current valuations. What happens to this? So whatever infrastructure they have, that depreciates over time, right?
Mm-hmm.
And so when you think about just from a depreciation perspective, look at the cash flow over here. I mean, how much depreciation did they experience here over the last year, right? $6.5 billion. So the assets of the company are diminishing in value over time as we're writing stuff off, and the debt itself, they keep expanding the amount of money they're borrowing. And again, this company has phenomenal margins, but the growth rate of earnings, and that's earnings are not cash. The growth rate of earnings are not at a level that really justifies even the current price or valuation of the company at this point. So let's think about it. So we're about to borrow $38 billion, right? All these banks are standing in the wings, waiting in the wings to be able to give this debt offering. Wells Fargo's there as well. JP Morgan, all these investment banks, other investors. So who are we building this infrastructure, this data center for? A private company, right? Ostensibly, OpenAI. Now, if we look at again, this is a private company, but the revenues for 2024, Blake, do you have any idea what OpenAI's revenues are?
I don't.
Okay,
That
so
one
in
I don't know.
2024, estimated revenue of OpenAI, which they're saying we want to do potentially do a $1 trillion, so they can get away from the nonprofit and get to a for-profit and do an IPO. They're saying maybe 500 billion of value. They're looking for $1 trillion. This company last year generated $3.7 billion in revenue estimated, right?
So you want 333 PE on your IPO.
Yeah. Now, we're talking phenomenal revenue growth because this year they're projected to generate $12 billion or $12.7 billion in revenue,
which
for
is
$1
4
trillion
times.
valuation. What's the revenue here for OpenAI for Oracle? $59 billion. Now, that's still way over a 10 times multiple. That's our price to sales is way out there, right? But again, so the deal that they inked with OpenAI, and they're raising $38 billion to do a data center. Okay, so remember that. The deal that they inked, OpenAI is going to pay them starting in 2027 for 5 years. They're going to pay them $300 billion. So wait a second. So how does that work, Blake?
I'm not a rocket doctor, a brain doctor, or brain rocket surgeon, whatever. But I can do this number, right?
Yeah.
If you're hoping to make 30 billion and you're committing to pay 300 billion, seems like you're upside down 10 times, and just
right.
revenue wise.
So Oracle doesn't have the money to build a data center. They're going out there at significant expense. Remember, this is going to come with the price tag is called interest expense. So they're going to have to pay the debt, finance the debt, in the hopes that OpenAI, over 5 years, that's $60 billion a year. Their current revenues are 3. Maybe we can get to 12, and maybe in 2 years we can get to 60. Now, the revenue story here, when we talk about AI, is really cringeworthy, because what is revenue? So when you think about a company generating revenues, what would you think that is?
Are you asking me?
Yeah, or anybody, right? You're thinking
What do
about
I think?
somebody's paying you money, right?
Yeah, you're selling a product or a service and you're making money, and
Right. Somebody's
therefore
giving you cash.
money comes into your building,
Right.
or
So
pocket, or POS.
they give up the money and they give it to you. Now, here's the deal though. Microsoft has invested in OpenAI. Well, how did they invest in OpenAI? Well, they basically mostly gave them credits to be able to use for their Azure platform. So here we are. Microsoft has all this compute that they can then sell. Instead, what they did was they say, hey, OpenAI, we're going to give you credits to use Azure. Now, I read a story that said they got about $1.8 billion left in their free credits, right? So the investment, it wasn't dollars invested in OpenAI, it was credits to be able to use the Azure platform. Now, here's the deal though, right? $1.8 billion left. Now, what Microsoft does is they invest in OpenAI with these phantom credits, right? To say, use our company. OpenAI looks at that as an investment, no cash invested, right? This is just saying, hey, you can sleep at my house, right? And so then we use Azure to use as the backbone to compute and for our AI model. And then guess what Microsoft does? They use those vouchers as revenue for their Azure platform.
Yep.
All these companies are doing that, right? So
it's the same thing NVIDIA is doing. They're just giving credits. You can buy our chips on credit.
On credit.
And if you don't use them, you give them back to us. So they're really not there's no money changing hands.
Right. So, I mean, CoreWeave, for example, right? So CoreWeave's out there. Here's a company, there's this investment company out there, attracts $230 million, $235 million. They give that $230 million to CoreWeave as an investment. Now, CoreWeave ends up giving them back 50 million in preferred stock, but what that investment company obtains then is $230 million in credits. And then they use those credits to go out there and invest in other new upcoming AI companies. Those credits then are transferred so then they can use CoreWeave for free, right? So again, where is the money here, right? So there was $235 million invested. CoreWeave the investment company keeps 5. They get 50 million back in preferred stock. But again, CoreWeave gets 230 million, net 180 million, but then they give right back all of these credits to use CoreWeave's platform for free.
Which then shows up as
revenue once they use those credits, right?
Yeah.
So
it's almost like accounts receivable that we're counting as revenue, but they're not accounts receivable, they're credits. It's like when I was in Spanish in junior high. We used to get Bueno Bucks.
There we go.
What good is it if I'm not at school? If hey, you did a good job. Here's 10 Bueno Bucks. If they don't have the Bueno Bucks store open, I can't take those Bueno Bucks and use them anywhere else. It's not real revenue.
Right.
I could not take my 10 Bueno Bucks and go buy a candy bar at the grocery store, but I could buy a candy bar at the Bueno Bucks store. It's the same game.
Exactly. Well, and it's like Dumb and Dumber, right? Here's a Lamborghini, 250,000.
You're gonna want to hang on to that.
Right. And then you get this receipt, this 250,000 Lamborghini.
An IOU.
Then you give it to someone else, right? For value.
Yep.
Right. Okay. Well, here's this. I'm gonna invest. Here's a receipt for 250,000 Lamborghini. Right. We got Dumb and Dumber over here, but this is as good as cash. So then I hand it off to somebody else and I'm investing in their company. No, I'm investing in Dumb and Dumber, but they're going to give me a percentage of their company. And here we have this receipt. Okay. And then we got to go collect on it. Right. So the problem is that you take companies that are basically saying, look, I'm giving away our compute. I'm giving away our platform. I'm giving away Azure, for example. I'm giving away AWS. Okay. We just had issues this week too. I'm just giving away and saying, hey, you can use it for free. Google, getting their platform. Oh, you can use it for free. And then they're cross-investing in these companies as well. So they're actually these Google, Amazon, they're investing in some of the same companies. But again, we're basically saying here's some free tokens to come in and use our, to come into Nickel City and play video games, right? Well, again, that the tokens I'm giving them is an expense, right? It's an expense on the corporate side. But then when it comes into Nickel City, I'm counting it as revenue for the AI. So if we're saying that total revenue of AI right now is 22 billion, the reality is most of that is free credits, right? Yes, we brought in a lot of nickels, but we gave away those nickels to come in and play these games and be able to come in and use this compute. It's a major problem. Right? There is no revenue currently backing AI. And what's happening is that costs are going up to be able to build out these data centers. At the same time, the actual price that you can charge to use it is actually going down. Now, this 38 billion is just the first data centers going to be built. There's 3 of them, 2 in Texas and 1 I think it was Wisconsin. But there's also problems in Texas. So if you guys have been familiar with the last number of years, it gets cold in Texas. What happens to the power in Texas?
I know.
Oh, go Blake.
The infrastructure collapses.
Yeah, the whole network goes down, right? They kind of detach themselves. They try to do it on their own, try to do some green energy initiatives. It ain't working in Texas.
Well, and Gianni talked about the fact that he doesn't even know if there's any in Minnesota by them because it is harder to do. We had our data center, which was small, we had $300,000 on the tiny little data center, $300,000 just as backup energy. That was just that's for a tiny little data center. We had to spend $300,000 just for backup energy. And yeah, so the more safe it is, the more protected it is, the better data center it is, the more expensive it is. And now all costs, because we have inflation, all costs because utility prices are going up, all costs because we need to start making these little micro nuclear centers, and that hasn't happened, are going up.
Right. So now to help protect from that, and who knows if this is actually going to happen or not, but they promise, hey, we're going to detach you from the broader grid, meaning that you're not going to draw power from public utilities and cause their prices to go up.
How's that
We're going to
happen?
create standalone power for you
Mhm.
that's not connected to consumer power, right? And current power that's going to retail and other stuff in the cities. We're doing standalone power. Now, that power has not been created yet, right? We don't have any sort of resources in Texas currently. They're going to have to manufacture this. I mean, you look at just that nuclear power plant in Georgia, for example. I think it was estimated to be like 1.5 billion. By the time it's done, it was like well over 4 billion, and they can't even produce cheap power, right, at a nuclear facility because of all the red tape. Maybe the Trump administration throws that out and can say, "Hey, we're going to be able to do it cheaply or more cheaply." It is still not cheap to produce even nuclear power these days. Maybe the smaller reactors, maybe stuff like that, but there's a whole lot of maybes here in terms of being able to provide power for Oracle and its data centers. So we have a revenue stream that the company is promising that we signed the contract with has nowhere close the amount of revenue to pay you, right? But you're taking on the debt, $38 billion, to build 3 of these data centers away from your business, which was software as a service. Then we got to
Yep.
power it in Texas, 2 of them, and there isn't currently the power production facilities to be able to separate them from the broader community power that's being offered in Texas. And when it gets cold in Texas, power goes out.
Right. So you have all the cards stacked against you. And here's the deal. Again, firsthand, I went through this. We built the data centers because we thought we were smart. We thought, hey, you know what? I'm not going to be the gold prospector. I'm going to sell the picks and shovels to the gold prospectors of the data centers of the .com boom. We thought we were brilliant. Let them take the risk. Let them do the things. But the fact is, our data center cost a lot of money.
Yeah.
And it was all based on all those prospectors paying us. You have one prospector here and huge amounts of debt. And so if that's the case, what happens when they don't pay their bill? You're betting everything on one tenant.
Yep.
And like I said, we had hundreds of tenants. And when they stop paying their bills, we're sitting there on a huge amount of debt and 0 revenue.
Yeah. And this is, again, essentially what Oracle has done, right?
Yep.
This company has no cash, very little equity. They have a great margin business that's just not good enough, right? We have a good business, but I guess to be competitive, but so far the growth has been good for Oracle. It's just been a poorly run company. And now we're saying, look, we're going to go out there and we're going to borrow money, right, from all these banks, and we're going all in. We're going all in on OpenAI and their ability to be able to scale up to $300 billion in revenue, which they have no model to get them there, right? And potential revenue. Again, they're not owning the data center, they're using other, but again, all this money changing hands virtually. The physical money is not there for many of these companies. And again, the idea is that the value of being able to offer AI as a service is diminishing. The returns, the margins, as more people jump into this, is diminishing. And what does that mean for a company that wants to dive into a whole business? It's a horizontal expansion. No, sorry, it's a vertical expansion rather. Not horizontal, it's vertical. And vertical mergers never work, right? Because you're going to cannibalize either this business or you're going to cannibalize the new business, which is the data center. And so again, it's not going to raise value. It's only raising the enterprise value because they're just taking on more debt.
Yeah, and someone said, Lloyd brings up the fact that GAAP allows for it. One of my favorite, because I've started with school in economics and then I shifted over to finance. So I took plenty of accounting classes. And one of my favorite jokes was that you had a job opening Have you heard this joke? You probably heard this joke. Had job opening, and there's 3 candidates. The interview goes through and asks them all the questions. They get to the end. The first interviewer, he said, "Okay, before you go, I have one more question for you. What's 2 plus 2?" And this guy's a mathematician. He said, 4. And he said, "Okay, thanks. We'll get back to you." Next guy goes through the interview, gets to the very excited. "Before you go, what's 2 plus 2?" And this guy's an actuary. And he said, "Well, with the margin of error of 0.00001, it's going to be 4 plus or minus that 0.0001. And he said, "Okay, thank you very much. Good to know. And we'll get back to you." The last one goes through, same thing. What's 2 plus 2? The guy gets up, looks out the door. He's an accountant. Looks out the door, looks around, says, "What do you want it to be?"
Mm-hmm.
So the accountants can adjust things. They can make things to be any number of things. But again, that's why we say act like a banker whose job depends on this loan working. You can make the numbers shift. Absolutely. You can add certain things back. You can take things out. You can do accounts receivable. You can recognize early and then undo it later if it doesn't come through. There's a lot of things that are accepted under the generally accepted accounting principles. That's why I say act like a banker. Is this loan going to survive?
Yeah. And everything comes back to, and everything then does come back to NVIDIA, right?
Yep.
I mean, at the end of the day, I mean, they're the ones that are out there saying, look, you want to build a data center. Here's our chips. And again, if you can't need them, just give them back to us. We'll finance your purchase. CoreWeave, they're putting all this, they have this investment in CoreWeave, and CoreWeave, what are these companies actually doing? Again, let's just quickly, just as a reminder here, let's bring up CoreWeave and CRWV. This is the largest single investment of NVIDIA in a company. So we look at the profile. What does CoreWeave actually do? CoreWeave offers a cloud platform, scaling, support, acceleration for Gen AI. Okay, its products include GPU compute, CPU compute, storage services, network. This sounds phenomenal, right? Great. Well, what are they actually getting in revenue? So we go to financials here. How much are they generating? $3.5 billion in revenue. Okay. And we look at, we go back to statistics here. This is a $68 billion company on $3 billion in revenue. So again, this is way, the valuation of this company is extreme relative to what? Relative to the amount of revenue the company's generating. And we go back here. What kind of cash flows is this company generating? Last trailing to was 637 million. It must be growing. No, it's actually gone from 2.7 billion to 637 million. They're generating negative free cash flow. Where's their investing cash flow? Cash flow from operating activities, net PP&E, right? They're investing $8.5 billion in net PP&E, right? They're trying to scale up. I want a piece of the action, right? GPU, CPU. NVIDIA is giving us these processors. They're allowing us to borrow money that we don't have to be able to build a data center with the promise that they'll buy it back if we can't use it. And so we're investing 8.7 billion, right? 2.9 billion in the last trailing 12 months, 8.5 billion on 637 million of operating cash flow. And it creates a free cash flow minus 7.9 billion. This is crazy, right? And who's paying them, right? Where are they getting the money from? We got 8.6 billion. Again, net issuance and payments of what? Come on. Debt, 7.5 billion, right? 6.4 billion. Okay. Someone's lending them money because of all these promises. And what's the source of the promise? It's NVIDIA, right?
Yep. And NVIDIA, one more thing that my son was asking, said, yeah, NVIDIA is now a $5 trillion company worth all, besides China and the US, there's no country that has more GDP than NVIDIA's net worth. Tell me how that makes any sense.
Yeah. 16% of you, 16%, right, of our US GDP.
Yeah.
Now, Blake, don't ask this. Go ahead.
I was going to say, and they don't make the chips.
Nah, this is going to go ask that. Say, what does NVIDIA make? Right? Nothing. They design.
They design and have the processor software, if you want to call it, but they don't make the chip.
Yeah. I mean, so again, Jensen just, talked to Trump, say, hey, we're going to build more, we're going to manufacture more chips in the United States. Well, they don't manufacture anything. Oh, we're going to do more out of our Arizona plant. Well, they don't have an Arizona plant. Who does? It's TSMC, right? So in the United States, NVIDIA, TSMC manufactures NVIDIA's chips. Again, they don't have any capability to manufacture anything. they have zero expertise in manufacturing anything. My son's in Taiwan right now. Here's a lot of stuff rumbling about tariffs. You know, TSMC is one of those companies, Taiwan Semiconductor. It's a big deal there, and then people are scared as a result of, you know, the tariffs and stuff. Of course, you know, Senate just rolled back Brazilians 50% tariff. You know, maybe the Senate would do something on some of these draconian tariffs, but the point is we look at NVIDIA. NVIDIA must have a huge amount of cash on its balance sheet to be able to ensure and take on the risk, right, of all these companies. This company they don't have a lot of debt, right? But 5 times more cash than it. But how much cash do they have? They've got $43 billion in cash. Wait, what's the size of their buyback, Blake?
I don't remember. 100 billion?
70 billion, I think it was.
70? I was gonna say it's almost 100. I thought it was closer to that.
I think it was 70 billion, maybe 100 billion in buybacks. They only have 43 million in cash. 43 billion in cash, rather. So, I mean, look, this is not exactly a company that's flush with cash. I mean, what happens if these again, CoreWeave, that if they cannot, because right now, again, all of these, you know, credits that are out there to be able to use compute and do it for free, you know, what happens when all of a sudden OpenAI's open credit line with Microsoft and the Azure platform, $1.8 billion left supposedly of their initial investment, which are just credits to use their platform. What happens if OpenAI has to start to pay for it, right? What happens if these companies have to start to pay for the compute, to pay for the data center, right? Now all of a sudden
they have
much
to,
less demand.
otherwise the people that are building the data centers, whether Oracle or Datadog or any of these other, are going to have to say, we can't keep the doors open. We don't have money.
Right. And
At
so
some point you can't pay for it with Bueno Bucks.
Right.
Oracle can't pay it with Bueno Bucks. CoreWeave can't.
Eventually that $250,000 Lamborghini that's as good as cash, that IOU, is actually worth nothing, right? So, I mean, the point is that we just have to understand is that this is something we maybe have seen to a degree, but I mean, even Cisco back in the tech bubble did not achieve the level that NVIDIA has here. And they're striking all these partnerships, trying to infuse themselves. Sorry, knocked over my water with my hand.
Go ahead and take care of it.
I didn't hit Jesus this time. So I have a Jesus statue on my desk because it's on our piano normally out here, but we still have still trying to figure out something in there. So our piano's not back in that room. But anyway, but again, we have all this stuff going on here that, again, what is the value that's underpinning all this? All we're doing is just growing it. Investors are just piling into it, or have been, without any concern about the actual ability of anyone to deliver on any of the promises, not just in terms of compute, but also the ability to deliver cash in the end for a service and generate real revenue. And so right now we're placating a lot of investors. Microsoft, okay, Azure generated this amount of revenue. Did it? No. They handed over a bunch of free credits, and OpenAI is using the Azure platform with the free credits. Azure is not generating any revenue, right? Or maybe relatively little. AWS, all these platforms right now, again, how much are they really receiving in value for the service? Right now, they're just using the credits to be able to invest in new startup AI companies. And right now, and quantum and all this other stuff, and it's allowing these companies to gain access to debt, gain access to the stock market, to issue new shares, all this stuff to be able to just, to create not value because there's no there. So if we look at RGTI, again, this is a company that's feeding off of this ecosystem, right? And if we look at RGTI, I was going to look at might be a little easier to see it here. And I do this just because for fun. Oklo, go down the list of these companies. No operating cash flow, right? 59 minus 53 million. Well, what's their revenue? $7.9 million in revenue. What is their market cap? $11 billion. This company doesn't even have a product, right? Will they ever have a product? Oklo. Oh, nuclear power, all this stuff, right? The promise of a power generation. We're giving Oklo a $19 billion valuation for what? This company's been around for years. There's no revenue.
Yep.
There's
So,
nothing there.
I did throw out really quickly that we are at 72% implied volatility on Oracle. So I do think a short-term short call vertical is a good play. I also put in the chat that a long-term out to February, March, long put in the money and selling premium November, December, January, February, March, you'll turn into a positive time decay trade on a diagonal within the next first roll, and it could become a massive, massive trade. But as we're watching all of this, you know, how do you measure goodwill? That's one thing I will tell you right now. Goodwill, yes, has value if you sell the company. We're talking about, would you loan this money because of how leveraged and debt laden they are? So if you're going to sell, or you know, the company, then that's when goodwill has value. Other intangible goods have value when in trading, meaning valuations in trading, and if you sell the company. Intangibles have no value in a default.
And that's the thing is, I mean,
if you close the books, you didn't pay your loans, they're not going to say, well, give us back the building and your goodwill. It doesn't happen.
Right. So Blake's saying, hey, you know, 72% IV. So we're saying, look, we're in the upper echelon. We're at 55% vol. When you're selling verticals, higher volatility means you can sell further away from the stock price. And then you have other factors like skew that might affect the credit you receive, right? But the level of implied volatility affects the distance you can sell away. How far out would you go? 50 days, 36, 22?
Well, I think you can just, if you want to do a quick grab, I just said do 3 weeks because that implied volatility is high enough, way ahead of earnings.
November's expiration. So we got 30 delta, where you at 30 to 40 range. So,
yep. Sell the 35 deltas and
35
buy the next strike out.
Yeah.
And it's moved since I set it up, but that's about where it's at. So, and it was a little bit higher, but anytime I can get 25 cents per dollar wide spread, I'm interested in it. Well, and that one's 82 cents instead of 62 cents, which is what it'd be for 250. So that one sets up pretty nice for a quick trade. But the long-term diagonal, I'm buying February's and selling the front month all the way through, and it turns into a positive time decay on the November to December roll, and then you end up paying for the trade by the time you hit February. So
so if you buy a February out here, you know, look, so in the money, 70 delta. We're on the delta.
No, we're on the put side.
Oh, sorry, on the put side. Sorry, 70 delta.
Yeah, I like to go with that 70 delta, and there's a 60. Yeah, I had to buy that one, the 310. Now you'll note that time decay is about $10 on there. So if I can get 60-70% of that in each front month, $6-7, that means I'll get November, December, January, February. I'm going to get about $28 against my $10 extrinsic value.
We're talking 35 delta here.
Yep. So that's even better. So you're going to get 750 for 4. You get 750 on that compared to your time decay. You'll end up collecting about $30 in time decay, and you'll end up with a spread that is $60 wide. And so it ends up bringing your cost down into the 20s, and you end up having a 60 or bigger spread by the time you get there, because you're going to keep selling the 35 delta.
And if Oracle just craters, right? I mean, you have a $60 difference here. Your net debt is 52.80. So if this craters and this goes deep in the money at 250, well, guess what? You still make about $7.27.
Yeah, and that's if it craters in 3 weeks.
That's if it goes boom in 3 weeks. But if not, if we just meander here, you just made 750 and then sell the next month. And if we meander down here, you'll
down again.
Yeah, you'll move that strike down.
That could be bigger and bigger and bigger, and your cost is getting smaller and smaller. You could end up with a $100 trade that cost you $25 by the time you're done.
So the worst case scenario is that Oracle just screams higher. But the second worst scenario is we drop significantly in the next 3 weeks, and you still make $7
on a $52 investment for 3 weeks.
All right, we are OT. Johnny is waiting the wings here, beard and all.
Sitting quiet.
So how long is that? How long has it been? A week? 2 weeks?
For what?
On the beard.
Oh, about a week and a half, actually.
And a half. Okay, I'm like about 6 days right now.
Okay, well, I didn't even have the let me see the zoom. Okay, I can't really tell. No, it's at 5 o'clock now. Finally,
there's a lot of white in there, but yeah, no, I can't grow this fast, and definitely not as thick.
Yeah, no, it's good. I'm gonna have mine for a couple of months now, so probably in the next year at least. So
I'll save mine in a couple days. But I was like, yeah, what can I do in a week? Oh, because you were gonna go to the beer. I was like, okay, I'm gonna compare mine to Gianni's in a week and see where I'm at.
Well, you know, Blake gives me a run for my money.
Blake's got a good beard.
Yeah. And Tony's
Well,
got the
thank you.
stash, you know, or the goatee.
He's done a
So, or
stash.
does Tony have a full beard right now? I've seen him in all different types of.
He had a full beard.
Yeah, full beard. Okay. And then there's Don.
Don is like
Don.
Brandon. Probably doesn't need to shave too often.
Yeah.
Anywho, enough of that. What are you talking about, Gianni?
Well, I have my eyes on the U.S. dollar. What a rebound we're seeing there.
Mhm.
And seems like it's causing some pressure in some other parts of the market. And I'm actually looking for bonds to be hammering on a low here. So that's what's on my agenda today.
I was originally going to talk about the dollar until Brandon and I were paired together for this session, and I agree with you. The fact is we overpriced cuts, and we had to unwind that. So the dollar is at these highs, and I think this is possibly the bounce time. So
Yeah.
it'll fit right with your
Surprising
bonds. I'm
gold.
with you.
Surprising gold's up 1.5%, almost 1.5% today.
Mhm.
Yeah. I love when the dollar and gold rally together because it stupefies a lot of people.
It's an unholy alliance. It's usually not good
Yes.
for the market if that happens, but
Yeah.
Yeah, it's all comparative. Everything's a pair trade. All right, we'll let you have at it, Gianni.
Cool. Thanks, guys.
yeah. Thanks, Blake. Thanks, Johnny.
Have a good one. All right.